All right, welcome to the Explainer. Today, we're diving into the daily stock update for early August 2025. And man, what a week. We just witnessed one of the most volatile stretches of the entire year. It was this incredible tug of war between pure fear and, well, pure greed. And it left a lot of investors just completely spinning.
I mean, think about it. One day, the market is just plunging, part of this big global sell-off. The very next, it's staging a historic comeback. It's just a textbook case of market whiplash. So the big question is, what in the world is driving all this chaos? Let's get into it.
Okay, so to really get a grip on this, let's just walk through the week's timeline. It was a total roller coaster. It all kicks off Monday with this huge global sell-off. Then, Tuesday and Wednesday, the market tries to rally, but it just fizzles out. But then, bam, Thursday hits, and it's the market's best day since 2022. It all wraps up Friday with some modest gains. Just an absolutely wild week. And what's just staggering here is the sheer scale of that reversal. On Monday, you had the S&P 500 dropping 3%, its worst day in years. Fast forward just 3 days, and it rockets back up 2.3%. A swing that violent in just a handful of trading days? Yeah, that's what put absolutely everyone on edge. And you could feel the anxiety spike. I mean, the VIX, which is basically Wall Street's fear gauge, it just shot up to a 4-year high. We're talking levels we haven't seen since the very beginning of the pandemic. So this wasn't just your normal everyday market jitters. No, this was a signal of some really intense, widespread fear. Okay, so what was spooking the market so badly? Let's dig into the case for fear, the whole bear story. It was really built on two things, some big global shocks and serious jitters that a recession was right around the corner here in the US. So the first big shockwave actually started all the way over in Japan. It had to do with the unraveling of this super popular strategy called the yen carry trade. Now, for years, investors had been borrowing Japanese yen at these crazy low interest rates to go buy higher return stuff like US stocks. But, and this is the key, the Bank of Japan finally raised its rates. All of a sudden, that whole trade just wasn't profitable anymore, and it forced a massive, super fast sell-off.
And the fallout from that, it was immediate and it was severe. The whole unwinding of this trade caused Japan's Nikkei index to just plummet, down over 12% on Monday. Get this, that was its worst single-day drop since the Black Monday crash back in 1987. It was a huge, blinking red light that one of the key pillars holding up the global markets was starting to crumble.
Then, that fear started to hit a lot closer to home. The U.S. jobs report for July came out, and it was a huge miss. I mean, only 114,000 jobs added. The unemployment rate ticked up to its highest level in almost 3 years. But honestly, the real shocker? It was the massive downward revisions to the months before. We're talking about wiping away over 250,000 jobs that we thought had been created. That really suggested the labor market was way weaker than anyone realized.
And if that wasn't enough, on top of everything else, a whole new wave of U.S. tariffs officially kicked in, hitting some major trading partners pretty hard. And listen, these weren't just small tweaks. These tariffs pushed the average tax on imports to a level we haven't seen in nearly 100 years. That adds some serious cost pressures and a ton of uncertainty to the global economy.
But then, the market does a complete 180. Right when that fear was hitting its peak, this incredibly powerful wave of greed just yanks everything back up. So now, let's flip the coin and look at the other side of this tug of war, the case for greed.
And a massive part of that rebound was driven by one simple but incredibly powerful emotion: FOMO. The fear of missing out. As one analyst put it, investors were just terrified of missing out on the rally. So after that huge drop on Monday, you had traders rushing back in to buy the dip, totally convinced the bounce was the real deal. Now, the absolute epicenter of this buying frenzy was the tech sector. The Nasdaq didn't just get its money back, so to speak. No, it surged an incredible 3.9% for the week and closed at a new all-time high. And that just shows you this unwavering belief people have in the growth of big tech, no matter what the broader economy seems to be doing. And this really put the market's laser focus on corporate strategy on full display. Take Apple.
Its stock had its best week since 2020, soaring over 13% after it pledged more investment here in the US. Then you have Amazon, and it's a completely different story. The stock got punished, plunging over 7% after hours, all because its cloud division showed signs of slowing down. The message from the market was crystal clear. We'll reward smart strategic moves, but we will punish any sign of weakness.
And look, this bullishness isn't just wishful thinking. It's actually being backed up by a surprisingly strong Q2 earnings season. A whopping 81% of S&P 500 companies have beaten their profit estimates. That's a blended earnings growth rate of almost 12%. That's a really powerful, fundamental tailwind pushing the bulls forward.
And this is where things get kind of weird, where we get to the paradoxical logic at the very heart of this rally. You remember that weak jobs report, the one that was fueling all the fear? Well, the bulls actually saw that as good news. Why? Because it makes it much more likely that the Federal Reserve is going to have to step in and cut interest rates to prop up the economy. In this market, bad news is good news. It's truly a worse is better world we're living in right now.
All right, on to the final piece of this puzzle. Politics. Because, of course, a political wildcard got thrown into the mix this week, adding a whole new layer of unpredictability to all this turmoil. So 2 major events sent tremors through the market. First, there was a public call from the president for the CEO of Intel to resign. And then, right after that weak jobs report came out, the commissioner of the Bureau of Labor Statistics, that's the independent agency that makes the report, was fired.
And that raised some serious red flags on Wall Street. The concern, as analysts at Barclays pointed out, is that these kinds of moves risk politicizing what's supposed to be independent, reliable economic data. And if investors start questioning the integrity of the numbers themselves, well, that undermines the very foundation the market is built on.
And all this political uncertainty is hitting at a really vulnerable moment. The stock market is already trading at a pretty high valuation. Its forward PE ratio is sitting at 22.2. Now that is well above the historical average, and it suggests the market is basically priced for perfection, which leaves very little room for error or for political shocks.
So, where does all this leave us? Well, the market is still locked in this really intense tug of war. You've got 2 equally powerful forces just pulling in opposite directions. On one side, you have real economic fear. And on the other, you have the sheer force of FOMO and these high hopes for a Fed rescue.
So, what should you be watching next? Well, this battle between the bulls and the bears, it's really going to be decided by the data that comes out next week. You'll want to keep a close eye on the U.S. inflation data and the retail sales report. Those will give us a real read on the economy's health. And crucially, we've got earnings coming from giants like Walmart and Home Depot, which will tell us a lot about whether the American consumer is still out there spending.
Yeah, this tug of war is far from over. The big question now is, can the market's optimism survive another dose of economic reality? Which one of these forces is ultimately going to win out? We'll be here tracking all the latest developments, so make sure to join us again tomorrow for the next update.